anytime you get into building something, there's always hidden cost and sort of bloat and leakage and other things that happen when you get into that process that you don't anticipate.
Hey everybody, James Shepard here with another edition of the Merchant Sales Podcast. Today we're talking about a topic that I love to talk about, don't get to talk about it as much as I would like, and that is finance. So specifically, we're talking about the payments industry, interviewing a guy who is a fractional CFO for a bunch of big payments companies. And so we're going to talk about things like how to get your financials in order to make sure you have an accurate representation of your payments business, right? You want to look at a profit and loss report and you want to be able to make good decisions based off that data. And so he talks about how to get your company in good financial shape, but then we go on to say, hey, how to take it and position your company to be able to raise capital, to, borrow money for growth or to do acquisitions, or maybe you want to prepare your company to be acquired and you want to maximize the valuation. How do you do that? So we talk about all of that and much, much more. Then we get some sales tips from Rich Norton. So we go from kind of high finance all the way to feet on the street and tactics and strategies that you can use to be more successful as an agent in the industry. And then Patty Murphy is going to give us a bunch of, I think we have 3 stories today from Today in Payments. We talk about the new stable coin that's coming out that MasterCard and PayPal have jumped onto with, I believe, Fiserv. We had a couple of other just really, really top stories right now that are happening. Very interesting stuff. We end up talking a lot about POS solutions and processor agnostic versus, in-house payment solutions as an agent or ISO. So a lot of really good stuff for you today. This podcast is brought to you by Nativia. Head over to nativia.com/ccsalespro to check out all that they have to offer. And as always, I like to mention that, nobody that I'm interviewing today or any company, there is a sponsor of the podcast. Rich Norton and his team is, of course, but the interview has nothing to do with that. Just somebody who's doing a great job in the industry. So with that being said, let's dive into this edition of the Merchant Sales Podcast. Hey, everybody. I'm here with Nolan Pittman. He is the founder of Profit Stream Solutions. How are you doing today, Nolan?
I'm doing really well, James. How are you?
I'm doing great. So I'm really excited, actually, Nolan, to have this conversation today. I don't really get to talk about finance as much in our payments industry. It's not a topic that gets a lot of attention. It should, which we're going to
Right.
do today. I personally love finance, as you know. You and I have had some good conversations around this, but I thought maybe you could start by introducing yourself and kind of telling our audience what exactly it is that you do, because I think it's a little bit foreign to kind of the ISO community.
Yeah, absolutely. So, Profit Stream Solutions, we specialize in fractional CFO work, specifically for entities in the payments industry. As you know, our industry has a lot of unique challenges with regard to finance, and a lot of these smaller ISOs, I think they set up a QuickBooks, or even larger ISOs, they set up a QuickBooks account and they start running their financials, and I don't think they really get that deep into the discipline of finance. And as a result, a lot of times they're flying blind. There's areas of risk, areas of opportunity that they're missing out on, margin expansion and things like that. And because the payments industry specifically has a lot of unique challenges with regard to finance, that's where we come in and help. So we kind of we kind of demystify, unpack the black box of finance in payments, and really empower our clients to excel in that area.
I love it. So just to be really clear with these ISOs, so if I'm an ISO, I've got a QuickBooks account, I've been in business for 4 or 5 years, I've got a pretty decent business going.
Yeah.
What specific things would someone like you do maybe I'm not already doing?
Yeah, sure. Number one, forecasting. So, by nature, right, finance is backwards looking. So you're looking at a financial report of something that happened last year, last quarter, last
Mhm.
month. Even our residual reports, right? They come out, mid-month. They come out a few weeks after the end of the month in which they're reporting. So you're already 3 weeks behind the curve. So one area particularly where we help a lot is we take all that data and we organize it and we systematize it. We create a lot of automated workflows, and then we try to develop forward-looking materials using KPIs, like key performance indicators, that allow the ISO and the owner of the ISO, the managers of the ISO, to start looking forward and setting performance goals and targets based on empirical data. And then what's interesting too is as they develop those forecasting tools, they can see as they start to compare the actual results to the forecast and they see that they're in line with each other. It gives them a lot of confidence that, hey, if we want to do this in our business, right, or we want to hit this milestone or this target, they feel a lot more confident in looking forward as opposed to always looking backwards. So that's one particular area that we help a lot. We can also help a lot with managing the very complicated just residual files
Mm.
You get these massive residual files with hundreds and hundreds of lines of data. It's very difficult to digest and synthesize that data in a meaningful way. So you're looking at the bottom line number, and I'm just pulling this out of thin air, right? If my residual check is $100,000 a month, as long as I'm kind of hitting that $100,000 a month, I'm happy, right? But I have no idea the ingredients that created that $100,000. And so our goal is to come in and help them create put a lens on that, right? Zoom in on that a little bit. Let's help you figure out if you're losing margin in certain areas, right? Are there certain areas of your book that you're overpaying or underpaying, things like that? And we can help them develop systems that answer those questions very simply and easily.
Mm. Yeah, it's just so interesting. I was working with an ISV over the last few weeks where they switched gateways,
Hmm.
and they're working with full stack payments. And there was a slight change that was made to the way AVS was run. And the
Hmm.
effective cost of interchange went from 1.64% to 2.15%. I mean, and this
Right.
is on a flat rate, program. So it literally cut the residuals by 30 something percent. And
Right.
if you're just recording the number, right, you don't even notice, you don't necessarily see that because it's growing really quickly, and you're like, oh man, we're not growing as fast as we thought. But there's just so
Yeah.
many nuances to that like a regular fractional CFO is of course never going to note it. They don't even know what interchange is, so
Isn't going to
they're never
understand
going to
that.
notice that. Yeah,
Yeah.
yeah.
The
So,
the the maze of interchange, right, in our industry, I think it's purposefully complicated.
yep. Mm,
But navigating the maze of interchange in and of itself is almost a full-time job. And when you don't have an understanding of how our system and our industry works, it's very difficult to come in and look at a P&L and even know where to go. So yes, a traditional CFO might come in and say, "Hey, here's your financial statements,
mhm.
and we're going to build some reports and some processes, and we're going to build a management dashboard, blah blah blah." But where I can add value is I've been in the payments industry for 15 years, right? I understand how it works. I can look at a P&L and I can say, all right, here's where we need to jump and look deeper. Because to your point, if you say, oh, it increased my cost by 20 basis points, right, which is 0.2%, it doesn't sound like a big number. But when you start to apply that to the scales of volumes, right, a million, 2 million, 5 million, $1 billion of monthly processing volume, the orders of magnitude increase dramatically, and it
Yeah.
can have a dramatic impact on your bottom line.
Yeah. So I want to go back to forecasting for a minute. One of the things that
Yeah, sure.
I one of the things I personally find super valuable that I think a lot of ISOs may or may not understand is that in their mind they're thinking, "Oh, okay, so I would work with a CFO to so that he can kind of in isolation go create some kind of forecast off of my numbers," which by doing so, you lose 90% of the value of creating the forecast. To me, the most valuable thing about the forecast is creating it. So when I'm working
Hmm.
with a competent financial professional and I'm going, okay, let's talk through our projections. And I say, like, I think we're going to do X. And they're like, well, why do you think you're going to do that? What are the assumptions that
Precisely. Yeah.
underline that? Because to build an accurate forecast, I need to know what assumption you're making, right? And this process of taking this like usually for me a good forecast, I got to work with a good CFO for 2 3 4 hours of just answering questions, talking through it. Then they go off and build something version one. They come back, we talk about it, talk about this process with a little bit. And
Yeah.
is this your experience as well? As far as is there this value, it's other than just here's a deliverable, here's your projection, here's your forecast of the value of
Yeah.
creating it.
Yeah, absolutely. Because every organization is unique, right? They have every organization like, they create their own approach to adding value to their customers, their approach to distribution. So yeah, absolutely. I'll go back to a personal experience that I had earlier in my career. I was working for a wholesale ISO, and we were heavily focused in public and education sectors. And the intuition you would have, right, in our industry is if volume is up, revenue should be up, right? But we were experiencing situations where in certain segments of our portfolio, volume would be up and revenue would be down. And I'm talking net revenue right after
Right,
interchange.
right,
And that's a whole nother topic of conversation of, what is your definition of revenue, right? Which is
right.
also an important conversation as a CFO. We'll set that aside for a minute.
Yeah.
The question was, why is volume up and revenue down? And we went through this exhaustive process of trying to understand why would that happen. And it took, working with our processor and understanding their reporting files to the point where at the end of that process, I had a forecast model that consistently we could predict with plus or minus 5% accuracy our monthly performance. Once I knew the volume,
Mhm.
um, I could basically run all the way down through the P&L, and I could tell you what our bottom line was going to be. And it was based on the fact that, yes, to your point, it wasn't just like, hey, I think we're going to grow 10% next year. We had to take each individual piece of the puzzle, which, going back to my opening comments, the complexity of our industry, right? You've got interchange, you've got your third party costs, you've got, and as a reseller, right, you're marking everything up and everything has a different kind of margin concept. If it's on a transaction, is it on a dollar? Is it on a click? Is it on an account? So there's a lot of this, like this complex puzzle. So the value of the process absolutely is getting deep in the business and understanding all the levers that come together and you can pull to create your margin.
Yeah, and I think as the owner of the business, you inevitably are going to uncover opportunities throughout that process that you just didn't think of
Oh
because
yeah.
it's hard to explain, and it's like funny having this conversation and trying to like explain this because it's really difficult to explain. But if you own a business of any kind and you've never really sat down with a financial professional and created a 3-year outlook, right? Going through
Hmm.
that process, I really believe is one of the most valuable things that you can do. So now let's talk about though the other reason why we might want to do that. Obviously, we want to make sure we have a good valuation, right, on our company, for a variety of reasons. Could be we're looking to exit at some point. It could be that we want to borrow money. We want to bring on an equity investor. Whatever it is, right? How do we, as an
Hmm.
ISO, a payments company, what are the key concepts you look at to help improve the valuation of a payments business?
Yeah. Well, I always say good internal controls and a good handle on your financial reporting, a good handle on your residual reporting is paramount.
Yeah.
Because if you don't understand your residual reporting, there's huge exposure because there's risk can hide anywhere in your portfolio. And so if you don't have a good handle on that, that's step number one. I think having a forecast, the ability to forecast and perform against your forecast, that's a very important concept as well. And when I say perform against your forecast, I mean the ability to say, I think if we produce this many accounts, that's our target, that's going to render these types of results in our financial statements. So that's another one. And I think also looking at your grasp of your pricing scheme and your margin scheme and how pulling different levers will affect the outcomes, and understanding when I say outcomes, not just income outcomes, but also attrition, right? So understanding, like, we have to
Yeah.
be very careful about getting out over our skis on these aspects of pricing, because we could run a model that says I'm going to add 5 basis points of cost every quarter for the next 3 years. But you're blowing smoke if you don't understand that that's also going to have an effect on attrition, which is a countering effect to growth. So those are all things, as well as just general concepts like merchant portability, good contracts, right? That's an area a CFO can help a lot, is coming in and saying, hey, I'm going to negotiate a processor agreement or a third party vendor agreement for you that allows you to have more control over your merchant relationship. Because buyers, when they come in and buy a book or buy an ISO, they want to know that they have control and they're not at somebody else's whim, right? When it comes to influencing that portfolio.
Mm. Yeah, it's so interesting, and I think it's so just having this conversation is so cool, and I think there's still probably a big gray area for my audience, which is they need to be able to understand the difference. Like you just talked about negotiating a contract or whatever. They need to understand the difference between an accountant and a
Mm-hmm.
CFO type situation, right? So, and you kind of you alluded to it already, but the idea is you need two different kinds of financial professionals on your team. One is that kind of backward looking bookkeeping. I need reporting so I can make good decisions, and we need to make sure we're filing our taxes correctly and all of those things. And so you have that aspect of your business from a finance perspective.
Mm-hmm.
Then you have the strategic implication of, okay, I got my
Yeah.
reporting and now I see what happened. What should I do now moving forward? And this is where you really need somebody that's a bit more of the kind of the business professional that's able to negotiate, help you think through merger and acquisition targets.
Mm-hmm.
Again, think through the implication of, okay, here's what's been happening. What's wrong with that? What could we change on a move forward, and how would that impact our results? But I don't know your
Yeah.
thoughts on that. But it's like I feel like a lot of times businesses get to this point where they're large enough that they maybe have a bookkeeper, maybe they have an accountant, right, that works for them.
Yeah.
but they don't understand the need for this other side. You know what I mean?
Yeah, absolutely. So, like to your point, you need both components to have, to me, in my opinion, to have what we call that concept of financial excellence. So, yes, you absolutely have to be able to represent your financial results well. That's where a bookkeeper, a controller, a lot of people use these outsourced accounting firms, which are very valuable and helpful. Um, but I'll use like an example of a question. Um, if you go to your bookkeeper and you ask the question, what would happen if we changed these aspects of our pricing model and we ran that for the next 6 months, the next year? What would happen? Most of the time, the bookkeeper is going to scratch their head and they're going to go into the historical results and they're going to be like, well, I don't really understand how to answer that question because they haven't gotten deep enough, right? They haven't gotten into the weeds on the numbers and they haven't built tools to allow you to accurately answer the question. What happens? What if, right? That sort of scenario modeling. And the tactical area of finance is looking forward, relying on the historical results and saying, okay, I know what's happened in the past, right? I have a really good grasp on it. I've gotten into the details. I understand my portfolio and the analytics of my portfolio. Now I want to start asking questions about it. What if I added 2 basis points to this MCC code? What if we changed our pricing model? What if we introduced, for instance, surcharge or dual pricing? These types of questions which rely on the ability to look into the future with an accurate model and answer the question, sensitivity analysis. These are things that a good fractional CFO can come in and it starts with building the framework and the foundation. Once you have the tools and the foundation, you can trust those numbers, right? You can start to do all sorts of stuff that'll unlock value, not just in near term, right? Like generating more profit, right? Growing the business, but to we're just talking about valuation, right? Long term perspective. Oh, ultimately, I want to sell this business or I want to raise capital. The more we can accurately look into the future and answer the what if question, the more value we're going to create.
Yeah, I love it. All right, so let's talk for a minute about sources of capital for ISOs. And,
Mhm.
they have a big decision to make there, right? So when you're talking to an ISO, the primary ones, of course, we have the idea of, borrowing against residuals. So we
Mhm.
can borrow money in that way. We have the more traditional, SBA 7A loan. And then we also have
Right.
that concept of equity. So give us just a couple
Mhm.
of key points of like, okay, you're advising an ISO, they're just looking to grow. Let's say they're maybe not looking to an acquisition. They just are looking to grow. They need to buy, they need to have cost of acquisition is going to rise. They're going to need to hire more staff so they
Mhm.
can scale up. What are the considerations when it comes to like, hey, we're going to raise capital? What are you talking to them about?
Yeah, that's a difficult position as an ISO and one that you have to absolutely walk through carefully. There are not a lot of traditional bank options for small
Right.
ISOs because
Right.
cash flow lending is tricky.
Right.
Um, and it can be expensive. So you have to get creative, right? I think that there are things you can do depending on the size of an ISO, right? You can go out, get it, you can get an acquisition loan. Sometimes you can go get a line of credit. Um, but I think if you're at a certain point and you are interested in growing and tapping into the resource of raising equity capital, it can always be an advantage. A lot of people they want to hold on tight to what they've built, and I want to own
Mhm.
100%. But a lot of times you're not just tapping into financial capital, you're tapping into intellectual capital.
Yes.
So if you go raise capital with somebody who's done it before, and there are a lot of people in our industry who have done it before and have been really successful, and they've got money, and there's also institutions, right, that are heavily interested in this space, right? Private equity and venture capital, the interest in payments and fintech as a whole continues to go up. So
Right.
bringing those people in, if you're willing to say, hey, look, I'm going to let go of a little bit of my ownership, you're going to get multitudes in return if you pick the right investor. However, if what you're talking about is very specific, I always tell people, look, let's look at your portfolio. Let's say strategically you've got a piece of your business that's very concentrated in what you would call like low risk, low margin, traditional brick and mortar business. But your sights are set on integrated payments, right? Everybody's talking about integrated payments. It's an interesting space. There's a lot to do. Um, you could use your own assets right? Like let's say you have, again, I'm using an easy number, $100,000 of residual, and 75 of it is concentrated in that traditional business, and 25 is in this new business. But the multiples in that new business are three times
Right.
what they are in the traditional business. I can sell a piece or all of that traditional business because there's a very liquid market for portfolios. And that's where a CFO can help. Somebody who's been through that process before knows how to help you negotiate that sale. But now you're using your own assets. You've held on to ownership. You haven't raised any debt. You haven't created debt service. Yes, you're eating into your residual cash flow, but if you're deploying that capital smartly, the return on that can be enormous. And the value of it is you're using your own assets. So that's also a consideration that can be scary if you don't have somebody who's done it countless times before walking you through that decision making process so that
Right.
you can go confidently into that process.
Mm. Okay, I have a couple of
And that's
other
where we can
just
help.
yeah, I love it. I have a couple other random things I wanted to throw out there. One of them is I want to
Mhm.
talk about hardware for a minute. So, one of the
Yeah.
challenges we've run into, right, is like you mentioned integrated payments. Okay, so we're gonna go integrated payments. Well, for brick and mortar, integrated payments looks like point of sale hardware, right? And
Mhm.
it can be 3, 4 thousand on a small deal. It can be 30, 40 thousand dollars on a big deal. Usually the
Mhm.
cash flow justifies it, right? From an ROI perspective. But if I'm an ISO and I'm selling two or three of these big deals a month like that, and then I've got 30 small deals a month, and each one of these deals is costing me, let's say, an average of $7,000, I may or may not have the money to do that. So, what are your thoughts on
Right.
different models or ways to structure that? Any kind of thoughts or how you advise ISOs in because this is something a lot of them are facing right now.
Yeah, that's a tough one. I mean, the benefit there is you have an asset, right? So you have inventory.
Right.
Banks are always more willing to give you money if they have something hard and tangible that, in the unlikely event you go belly up, they can sell and get recoup their credit. So I would always start, if I'm in that situation, I would always start with going and finding. There's a lot of banks that will offer creative financing options like that in our industry, and there's more popping up every day.
Hmm.
Um, just having a network of access to them, that's one place we can add value is just knowing who the people are, right? Who do you call if you wanted to do, like, for instance, a purchase order? Some of the larger POS vendors will offer you financing options. So that's an option as well, and
Sure.
you could also go to your processing or ISO partner, right? If you're boarding business with a large super ISO or a wholesale ISO, you could go and approach them and say, "Hey, I want to launch into this space because I feel like I'm going to get great traction. I've got a good product, but I don't have the capital." You can always play with your residual cash flow stream as well, which is a huge benefit. So let's say you go on a 90/10 deal. You could play with the idea of giving somebody a lender, right, access to some of that, even if it's just for a period of time. But there's a lot of ways you can use, creative financing to do that. If you can't go the traditional financing route. If I was advising an ISO, my position would be let's start with a bank, because you never know what you're going to get. Maybe a working capital line of credit that allows us to finance the purchase of inventory in
Right.
bulk, right?
Yep.
And maybe the model is we don't just give the inventory away. Maybe we rent it and we make it we create a margin stream off of that. So if we want to go buy, $50,000 worth of POS equipment, hold it on our balance sheet, and charge $15 a month for our setup. Well, now we've created a new income stream, and the payback model on that, we can run that math easy. Could be huge. So there's a number of ways to turn that sort of daunting, intimidating process into something that actually can be quite advantageous.
Yeah, I'm such a huge fan of the model you said there at the end, because ultimately holding these assets on your balance sheet, and even I've helped companies where they've set up a separate entity to do this, right? But if they're larger, but
Hmm.
like holding that asset and creating that income stream, certainly, you can always go the leasing or different routes where you kind of are outsourcing that finance piece, but you lose that opportunity to create that recurring revenue. And to me, our business is all about recurring revenue. It's just that on the hardware side, it costs money up front, but it's not
Yeah,
that,
absolutely.
yeah, it's not that difficult. There's so many, I think about, Super G or Nativia Financial, Funds for Growth,
Yeah.
Bill Healy. There's so many of these different companies that it's like, okay, I've got my 100,000 a month in residual. Well, if you know for sure that you can deploy this hardware and it's going to break even in 12, 16, 18 months, you can arbitrage that all
Hmm.
day long, right? Because
Absolutely.
you're going to borrow the money, and even at a high interest rate, that as long as the cash flow that you generate from the asset is greater than the cost of capital to buy the asset, you just created arbitrage. And especially in a debt scenario where you're going to
Yep.
pay it off in 16 months and then month 17 and forever, you get to keep all the money. That's a pretty good deal.
Well,
So,
absolutely, and you take the fact that a lot of that equipment it gets deployed and then it gets recovered. If obviously you don't anticipate merchants closing, but somebody goes out of business or they
right,
just find another solution that they like, you recover that asset, you can redeploy it.
right. And
Except the
it's your
next when you
asset.
redeploy it, it's your asset, right? When you redeploy it, you've basically fully depreciated it at that point, and you've got a 100% bottom line cash flow stream from an asset that basically somebody else paid you for. It's kind of like somebody else you go buying a car and somebody else paying the monthly payments for you, or you renting a house and somebody else paying the mortgage payment for you. It's the same concept.
Yep, that's the way I look at it all the time. People will tell me, friends of mine that are in the real estate industry, and they'll say like, "Oh yeah, I went and bought a rental house, and I put $10,000 down. I borrowed 130,000 from the bank, and I'm getting $1,600 a month in rent." And I'm like, "Well, you go do that all day long. Last month I financed 70 POS deals, and each one cost an average
Yeah,
of $7,000, and each one's generating me $500 a month." Like
yeah,
I'll take
yeah,
my ROI all day long over yours. You know what I mean? Like,
yeah.
and it cost me literally nothing. I got the financing for all of it. So it's like, that so it's an amazing industry. I think if people understood really how to deploy capital, it's really incredible.
Well, see, that's what's cool about our not to stick on this point too long, James, but that's what's cool about our industry too, is you can take that we can, as a fractional CFO, we can come in, we can help you build a really kind of robust case study on that, and put together a little, a little bite-size offering memorandum that's easy to understand. You could go talk to anybody in the industry that has cash because
Right.
our industry is notoriously good at being helpful. And people, we have a lot of capitalists in our industry, as you
Yeah,
know.
for sure.
And I mean, they don't even have to be a bank. If you go to somebody and say, "Hey, look, this is an opportunity, and I know we can do this, and we can generate this kind of growth. I just need the cash." Even if they're not a traditional bank, I'm sure you'd find people that have
Oh yeah.
experience in our industry be willing to sign up for that deal all day long.
Oh,
And
absolutely.
and so
Yep.
it's just so
Yeah. All they wanted are the controls in place to say, we'll lend you X as long as it's going to produce Y. And so as long as you get that
that's
X and
right.
Y figured out, and then you're fine. One last kind of big question here is a lot of ISOs in the space right now. One of the reasons why they're looking at their finances differently is that they recognize that change is happening rapidly, especially in integrated payments and software. And so a lot of them are looking to say, do I need to buy a software company that's vertical specific to go after, maybe this particular ISO is really good at going after dentists and they want to get a dental software, or maybe they want to go after pizza shops, so they want to get a pizza shop POS system. Talk about this concept of buy versus build. If I'm an ISO and I'm like, okay, I really want to start getting into integrated payments myself, right? What are some things I want to
Mhm.
think about in terms of looking for that acquisition target, and or oh, I want to convert into more of a tech company, I need to hire a developer. Like, talk about that decision a little bit and kind of how you're advising ISOs.
Yeah. Well, you always want to start with kind of your um, I guess your matrix on what the needs are for the specific vertical that you're looking at. And if the needs are being met or can be met with existing third-party solutions that you can assemble into kind of like a proprietary blend and just build a small piece of middleware or a small connection point on top of that to make it proprietary. Um, I think that's always a better solution because somebody else has already taken the arrows for you.
Hmm.
But said differently, if you're looking at a set of unique needs that is really unmet today and there's not a solution for it, even if you got, kind of bring in the small tent poles into the big tent. Um, that's a situation where maybe you look to acquire somebody who's serving that need in that space, or you build it yourself from the ground up. Because the I guess the signal there is, hey, we have the first mover advantage here, right? And we can really embed ourselves in this industry or this vertical, and represent ourselves as kind of like the unique offering, and take advantage of the fact that there's not a need being met today. But there has to be a heavy discipline on the financial components because anytime you get into building something, there's always hidden cost and sort of bloat and leakage and other things that happen when you get into that process that you don't anticipate. So you might put together, oh, if I do this, and this, it's going to cost me 600 grand.
Mhm.
That project inevitably is going to end up inflating by 20% just through the natural process. Things go wrong. Versus acquiring an asset that's already working today, you kind of know what you're getting. So it might be
Yeah.
more expensive, but you eliminate the risk
Mhm.
of the build process. So I always advise my clients, let's sit down first and figure out what are the needs, right? What solutions exist today? What does the competitive landscape look like? And then from there, let's figure out how we can put together a strategy that will allow us to deploy capital. It's not necessarily about spending the least. It's about spending the amount that's going to get us the most on the back end, right?
Right.
What's going to allow us to effectively mine through this vertical for a long period of time, right? Build durable competitive advantage and things like that.
Yeah.
It's not necessarily about going on the Jeep.
Yeah. I wasn't planning to share this, but just because we are talking about this, I'm like, I wanted to share a little of my secret sauce for a second. I'd love to get your thoughts. One thing I think ISOs don't understand yet is like such a game changer is how to structure an acquisition of a software company. So I want
Hmm.
to just talk about this for a second because I think it's so cool. These vertical SaaS companies, right? A lot of them really don't understand payments at all. And so they might
No.
have, 10% of their book is currently using their own payment processing, let's say, right? Or maybe it's 20%.
Mhm.
And then they also have their SaaS revenue. So they have recurring revenue. And we have an industry that values recurring revenue, right? Like we know how to
Oh,
value that.
100%.
It's a
Right.
liquid asset, right? That you can use. Well, the software companies don't understand that. They're thinking more of the VC world. They're thinking equity and all this other stuff. Well, one of the things that you can do
Hmm.
if you get software company that is smaller in size and scope than your ISO. So that could mean a lot of things. If you're a big ISO, it could be a big software company. If you're smaller, it's a maybe one that created a
Right.
great tech, but they didn't know how to do distribution and they kind of flopped. Well, when you go in there, you can say, okay, today they've got, let's say, 100,000 a month in recurring revenue. Most of it is SaaS, right? But
Hmm.
you realize that, hey, if I flipped all of their clients to my payment processing, I could probably get 65% of them to switch and I would lose the other 35%. Well, you can get a
Right.
CFO to run those numbers and go, well, what does that look like over 6 months? Then you go to the founder of the software company and you say, hey, I will give you, let's say, $1 million up front or whatever, which that million is secured by the 100,000 a month that they've already got or whatever. But then you
Right.
do the deal and say, hey, here's what we're going to do together. So I want to buy your company, but I still want to give you like a synthetic ownership stake, or maybe they have a small interest still. Then it's like, hey, we're going to
Hmm.
work together so we can get the integration done with my payment processing. And then we're going to flip your
Hmm.
book. And over the next 12 to 18 to 24 months, if we can work together on this, you're going to get a total of $8 million. But
100%.
but
Yeah.
nowhere along that path did you ever spend any money because
No.
you're leveraging the recurring revenue to get the first million. And then as the recurring revenue
Right.
grows over the next year with your distribution channel, but also just by flipping existing book, so it's really a cool thing because the founders are like, well, this is fantastic. Like, they're thinking their business is
Yeah.
currently worth 4.5 million, and you're like, no, it's probably worth 8 million, but I can only give you one and
Yeah.
a half to 2 million up front because in order to make it worth 8 million, we have to work together to flip the book. So I just
Yeah.
want to throw that out there. It's kind of an interesting structure that I've been playing
No,
with on deals.
I think it's brilliant, James. I think that's really, really smart. And I think the other thing to consider is that a lot of vertical SaaS companies that are run by people who come from the SaaS world, they're intimidated by payments
Yes.
because let's face it, you start getting to the concept of, registering with the card brands, managing an ISO, all the compliance requirements go into that. And heck, just put a residual statement in front of them, right? Or a residual file in front of them. And they
Right.
look at, 17 columns of revenue and it's all, acronyms that they don't understand. And like that can be really intimidating when you're used to
Yeah.
clicking a button, and saying, hey, I'm charging this guy for our base model or I'm charging this guy for our premium model, right? They've got two products.
Right.
And we theoretically, in our merchant statement, you look at a merchant statement, right? How many lines of revenue are there? I mean, one merchant statement alone, you could have 50, 60 lines of revenue. It's insane. So the value is you come in and say, hey, look, we understand that, right? We live in that world. We're used to it. Um, we can come in and demystify that and create value by going out to the rest of your book and saying, instead of outsourcing your payments or letting the payments be handled by somebody else, let's take control of that piece of it, right? I think
Hmm.
the term that we use now is monetizing payments.
Right.
Um, Almost to the point where you could say you could give your software away, right? You
Exactly.
could give your
Yep.
software away if you're effective at pricing your payment model
Yep.
and you get captive resource where everybody in your book has to use your payments. And instead of making them feel like being they're held hostage, you're making them feel like you're getting a valuable option, right? Because it's all
Right.
embedded.
Right.
Um, you can start to give the software away for free and completely eliminate the friction, right? And they just pay as they go. It's like a pay as you go model. And
Yep.
we've seen that a number of times. So in an acquisition, it's the same thing.
Hmm.
You can go to them and say, hey, I know a way to basically quadruple the size of your business or more, in a relatively short time frame. And all I'm asking you to do is basically hand over the keys, right?
Right.
And you can be along for the ride. You've obviously built a great platform here. The technology's great, but you're you're missing the biggest piece of this. So let's
Right.
help unlock the
Right.
value.
Well, yeah, and again, you need that person. I mean, you still need that founder because there's most likely a payment integration coming, which is not trivial. And then there's also like
Right.
you're probably not a technology company. You're probably not a technologist, right? If you're an ISO, and so
Yeah.
the idea of saying we're going to become a technology company, no, you're not. You can acquire a technology company, and that could start to change your culture in that direction. But that's how I love that model too, because it's in my opinion, it's the best way to kind of aqua hire. It's like you're bringing in the tech talent, and
Yeah, absolutely.
that's gonna impact every side of your business. So, well, I'm sure we could go ahead, Nolan.
I would just say, yeah, you're using you're using the exist like you said, you're using the existing resource to unlock the value. And I was just going to bring it full circle back to like what we were talking about, a fractional CFO, having somebody like that on your team as
Yeah,
an ISO as a differentiator, because in our current industry, as an ISO, differentiation is key.
yeah,
So if you're an ISO and you've gotten really deep in a vertical and you're like, hey, this is great, but it's missing a real solution here. And you want to tackle that kind of like scary thought of like, what if I went out and bought my own piece of software,
hmm,
right? You bring us in, we'll sit down with you, we'll create a thesis around it, and we'll make it really, really easy for you to feel confident that you can approach that conversation with the vertical SaaS company and consummate the transaction. And now all of a sudden you went from just being another ISO to an ISO with a proprietary solution in a vertical that you love, and it's going to change your cash flow today, and it's going to change your enterprise value in the future
yeah,
dramatically.
absolutely. And that it's so important too from a confidence perspective, even from the acquisition target, because when you go in and you're like, okay, here's the terms of the deal or whatever, and it's like, all right, let me introduce you to my CFO, who's going to help us put this
Yeah,
together. That makes them go, oh wow, okay, this company's really established. They have a CFO. This is great. Somebody knows what they're
yeah,
doing.
it legitimizes you, right?
It does. Well, Nolan, before I let you go today, and this has been such a fascinating conversation, we'll have to have you back on in the future and continue, but I want to give you an opportunity to just share with my audience if they want to learn more about working with you as a fractional CFO. Maybe you could explain a
Mhm.
little more in detail of what does that mean in terms of time commitment? Like how often are you normally meeting with these people? Give us like the elevator pitch version of that, and then where would they go to learn
Sure.
more about you?
Yeah, we built our entire concept around this journey to financial excellence. And there's a number of different elements of that, but a lot of it comes down to building a foundation, building some workflows, and then building that future looking component, right? And we can walk through that process. We can kind of come in at any point in the process, but working with us, typically what we'll do is we'll sit down with the founder, we'll sit down with the managers, we'll figure out what their needs are, what their goals are, and we'll structure a package that could be a monthly commitment, right, where we're coming in and as a part of the team, right? Effectively, think of us like a member of the management team, or it might be project based, right? Like you said, maybe they want to do an acquisition and they just need somebody to come in and help them build the thesis and consummate the transaction, and then the project is done. But in any case, we're very open ended. Like to get our hands dirty, roll up the sleeves, you really get immersed in the business. So um, the model's pretty open ended, but it's all built around that concept of journey to financial excellence. And you can reach out to us at profitstreamspro.com. There's a contact form, and feel free to submit that. It'll schedule some time on the calendar, and we can sit down and chat about what your needs are and how we can help.
That's great. Well, Nolan, thanks again so much for taking the time to share all this with us today. Really appreciate your insights and wish you great success.
Thanks a lot, James. Really appreciate it, man.
I'm back here today with my good friend Rich Norton. How you doing today, Rich?
I'm very awesome. It's another day in paradise.
Yeah, absolutely. So we always record these things in batches, right? So we last
Yes.
week you all heard Rich talking about the opportunity and just the incredible opportunity the payments industry is. Today, Rich, I was hoping you could tell us a little bit more about what does that first 30 days look like. So I've been selling cars. I now decide I'm going to go sell payments, which is actually a pretty common transition.
Yes.
What does my first month look like? What I get up in the morning and do what?
Great question. So I tell everybody the first year in this industry is the most challenging. It's important to get with a team that you can make a lot of upfront money because we talk about residual income. You're not going to get that residual income right away, but you want to make sure you're making good upfront money while you're building that residual income. So the first 30 days, and I'll talk specifically on our team, and again, get with the right team. What we do is we introduce each one of our representatives to a field leader, a mentor, or a coach. And what they do is they navigate them through what's going to happen each step of the way, each day. We navigate them through our terminals, through everything else, all the processing. We teach them about cold calling. And the goal is to be in production within your first week to 10 days. We want you making money right out of the gates. A lot of times people come into the industry, it's like, well, I got to get another job because I'm not going to make any money, or I got to get a part-time job. It takes a year to start making money. That's not true. We have representatives that make six figures their first year, lots of upfront bonus money. They work hard doing it, but we do that having a mentor. And then I put together a university. And in this university, and you'll relate to this, we love to make videos. It's 18 videos with a quiz at the end of each video. It's on the Canvas platform. And we're upgrading these again because things keep evolving,
Yep.
things keep changing. So with that, they're going to learn the ins and outs of the business. Like people start out, it's like, where do I begin? Where do I start? We start out right away with, this is your business. We're putting you in business for yourself, but not by yourself. How do you get yourself set up? Do I become an LLC? Do I become a corporation? What type of bank account? How do I do my taxes? All that, all the important things that a lot of people don't think about. And then a year goes by, it's like, oh, never thought about that. So we want to get all that out of the way, how to get your business started, but how to prospect is a big part of it. Like we can learn all about these products. We can learn all about these services. And I love it when people say, I'm not going to get out there until I know everything. Well, you're not going to know everything, but we're going to teach you all the basics. And we want you to get out there in the field. And we're going to teach you like how to cold call effectively. And there's so many different niches. There's so many different ways of doing it. We teach them all, like how to develop partnerships, how to work off referrals. One of the big things that we teach all our representatives to do right away, get a warm list. Think of all the businesses that you know. Think of your family. Think of your friends. Start out with them, that low-hanging fruit. Let's get some deals under your belt. Let's build your confidence. And the goal minimum is you want to write 5 deals a month, especially your first month. So mainly is just getting people making money right out of the gates. But we want every one of the representatives never to feel like, I don't know what to do. I don't know where to start, because I hear that all the time from all the calls that I get. I'm out here in the field. I don't know what I'm doing. I'm getting all kinds of rejection. I feel like just giving up. We never want anybody to feel like they're out there on their own. So we have group me apps, we have Facebook pages, we have a website, we got videos. I bombard everybody with motivation sales training. If you're part of my team, you're going to get a text probably about 5 o'clock in the morning, and your family will say, who is that crazy? And that's what we do. Start your day off with motivation, inspiration training. All of our field leaders and our coaches, they have meetings with their representatives. They have Zoom calls throughout the week. We need that. We have to have that, because otherwise we're just doing the same mistakes over and over again. And it's important to have motivation, sales training, inspiration. All that is a big part of success. So don't be a lone ranger. Join a team and be part of something that's exciting. And that's what we're doing.
Yeah, and I think it's interesting, Rich, because when you get into the business, it can be a little confusing because you do have some processors out there that have W-2 employment positions,
Right.
right?
Yes.
That's not what this is. You have a 1099 team, but a lot of times the
Correct.
1099 teams, they do kind of leave you out there as the lone wolf, and that's not really great either. So I think it's interesting what you've done for the newer agents to the industry. You kind of have that mixture of, hey, there's voluntary training. You're not required. No, you can't
Yes.
require. It's 1099, but here's all these resources that if you want to be successful, you can tap into these. But at the same time, you still have that flexibility and freedom of the 1099 position. So I think it's a really cool mixture. Rich, for those who want to learn more about it, where would you send them to learn more about your team?
Yes, absolutely. Reach out to me, Rich Norton, 904-434-4635. You can email me at payrock, Payroc, Rich Norton at gmail.com.
Awesome. Thanks so much, Rich. Always appreciate it.
Thank you. Appreciate you.
Hey, James, there's lots of news out of Fiserv this week.
Okay.
First, the company announced a collaboration with Early Warning Services
Okay.
um, that will allow it to support ISOs and agents selling this. What is it called? Pays. It's a digital wallet that Fiserv. Besides being huge in the merchant services business. Before it got into that, its business was providing back end support for financial institutions.
Yeah, for banks. Got it. Yep.
Right, banks, community banks, and credit unions. So now it's going to offer this pays, which is early warning has created a new digital wallet
And
called
early what
Pays.
I'm still a little confused on that. Early warning of what?
Early Warning Services. It's a company that's owned by all the big banks.
Oh, okay, okay. So there's a company called Early Warning Services or a product
Right.
or something. And what does it
Okay.
do?
It does uh fraud and risk reduction, risk identification, fraud reduction. It's
Okay.
sort of like a fraud engine. It's owned by all the biggest banks, B of A, Chase, Wells,
So
all the
basically
guys that own RTP also own
okay, so the big banks
Early
are
Warning.
basically all pooling their resources and their data to be able to predict fraud and things like that. And
You
they
got it.
have okay, I got it.
You
Okay,
got
all
it.
right. Now I know what we're
So
talking about.
so
Okay.
so Early Warning is the company that operates Zelle.
Got it. Oh, really? So I knew that the banks all kind of had this vested interest in Zelle, but I didn't realize so that's part of the same entity. So
So
they all
that's how
collectively
they have the
own.
vested interest in it. Yes.
Oh, so interesting. Okay, well then it seems like Zelle should be better at managing fraud. But anyway,
You would think so, right?
right?
Um, but so now they're doing this thing called Paze, Paze,
Okay.
which they're going to market to, um, you know, Fiserv's financial institution clients so that they can have their own, the First National Bank of Erie can have its own digital wallet,
Mm,
branded itself. Which, I'm not
interesting.
sure there's that big of a need for that, but I think,
Hmm,
the fact that you have Fiserv, which is huge, and you have Early Warning, which has the corner on fraud prevention and risk analysis,
right.
tells me that, there must be some kind of demand for that out there.
Yeah, I would think. Very interesting.
So,
Okay. Yeah.
okay, and
Well, I'll
then
be interested to see how that goes.
it also announced, Fiserv has also announced plans to launch a new digital asset platform along with a stable coin, FIUSD.
Okay.
At using the asset infrastructure from Paxos and Circle Internet Group, which are both active in the stablecoin world in terms of issuing and managing tokens, that represent the money behind stablecoins.
Mhm.
Fiserv also announced that it is partnering with PayPal to build future interoperability between FIUSD and PayPal's stablecoin PYUSD.
Okay.
And just almost immediately, it's like these announcements are coming one day after another. Boom, boom, boom.
Right.
And the latest is a partnership with Mastercard to explore ways to integrate FIUSD across Mastercard's products and services.
Mm.
Stablecoins got a big shot in the arm when the Senate passed the Genius Act. That's
Yes. Yes.
of course, it still has to get through the House and before it can be signed
Right.
into law. But
It
the
looks
betting
likely.
is the betting is that it's gonna become law.
Right.
And a lot of the reporting I've seen in the Wall Street Journal just had an article I think this week about are stable coins going to make Mastercard and Visa obsolete,
Mm.
or at least dig into their duopoly.
Right.
And so I think that's a really, to me, this MasterCard deal with Fiserv is really big because
Yeah.
it's going to give it a leg up on
Mhm.
Visa, at least for
Well,
the time
well,
being.
and I think both Visa and MasterCard have made it clear that, maybe a simplified way of putting it is I think that Visa and MasterCard want to become the gateway for
Right.
crypto acceptance, if that
Yes,
makes
I think
sense.
so.
I,
It
I'm,
makes perfect sense. Yes.
it almost feels to me like when you see the deals that Visa is doing and the deals that MasterCard is doing, it's almost like they are understanding the importance of being not just the rails, but also the gateway
Right.
to allow businesses and to accept and allow consumers to spend using crypto.
Right.
And so it's a very interesting long-term bet on their part. I think it's the right strategic move. I personally, and it's funny, we're gonna have you introduced me to a guy I had a long conversation with yesterday about
Oh, you
Bitcoin.
didn't have him. Great. Glad you guys got together.
Yeah, but we're going to do a podcast episode coming up soon, and we'll talk about that. And so it's interesting because I think long term, it's still a bet, right? It's like we don't know for sure. Is it going to be stablecoin? Is it going to be Bitcoin? Is it going to be a combination? Is it going to be
Right.
mainstream? But I think it's the right bet because if it goes right for if stablecoin takes off or whatever, it is a big threat to Visa and Mastercard, and so it seems like it's something they should be playing. It's somewhere they should be
Definitely
playing.
something they need to be playing. A few,
Yeah,
a a sandbox they should be playing in,
there you go. That was
so
the
to
analogy I
speak.
was looking for there. Thank you.
Right. Um, but yeah, I'm interested. That guy I interviewed him for a story I did for the Green Sheet, and
Yeah, yeah.
he's really on top of this.
Yes. Yeah. Very
The only
interesting
ISO I
conversation.
know that's dealing in crypto.
Right.
So anyway, so that's the big
That's
deal.
story number one,
That's
right?
story number one. Number
Yeah, we got two
two,
more.
yeah, two more. Payments is rampant. We all know that, right? I mean, FTC, the Federal Trade Commission, reports that non-card payments fraud rose 271% between 2020 and 2024.
Right.
And the Treasury Department reports that suspicious activity reports, that go through the Financial Crimes Enforcement Network.
Right.
So suspicious activity reports related to check, ACH, and wire fraud rose nearly 500% in the 10 years in 10
Wow.
years between 2014 and 2024. So it's rampant. So it's across all systems. Most notable, though, it should be said that the rise in check fraud is really spiraling out of control, which is really interesting considering the continued uptick in digital payments. But I
Right.
think that what they're saying is that because there's fewer checks, it's easier to you know pass that along. Like
People aren't as prepared to identify the fraud because they're not seeing it as much.
right, exactly. And
Hmm.
people like the people are going into mailboxes and taking oh, this looks like a check, we'll take this one out, and
Right.
then
Right.
they change the amount and cash it,
Right.
and then I'm like, James, where's that check you sent me? you
Right.
know
Right. Yeah.
so
Interesting.
anyway, so here's the thing. Regulators have issued the major financial institution regulators have issued a request for information on fraud. What what are some collaborative and independent steps regulators could take to help
Mm.
mitigate fraud for the financial institutions they regulate? It came out of the Federal Reserve banks, as well as the Federal Reserve Board, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of the Currency.
Hmm.
They pose 22 questions that they want people to answer to give them a sense for what they could be doing to help FIs staunch the spread of fraud,
Yeah. Yeah.
which I think is very interesting.
Hmm.
I've been covering payments for a long time. I've never heard of, right, outside of FinCEN and suspicious activity reports, I've
Hmm.
never seen regulators say, "Hey, let us help you combat fraud,"
Right.
and they're in a perfect
Right.
position to
Which is
do
what they
that,
should be doing. But yeah, that's
which
great.
is really what they should be doing. But it's not something they really
Yeah, it's
have
not
been
common.
doing. They've been
Hmm. Okay.
saying, they've been going through financial institutions' books,
Right.
during examination processes and saying, hey, you have your fraud numbers are up. You need to be, go to
Right. They're
early
they're pointing the
warning
finger, but
services
they're
or
not
something.
they're not collaborating and partnering. And so now they're potentially
Exactly.
doing that. So great.
So
Well,
that's
that's
a
good
big
news.
deal that they want to
Yeah.
collaborate with financial institutions.
Okay. All right. That's story number two. What's our
And
third one?
number three, the is out of the hacker group.
Uh-huh.
As we've noted in the podcast numerous times for the last several years, the point of sale is no longer just a transaction tool.
Hmm.
It's where data and customer experience converge to to shape the future of business management.
Right.
You know, so with that in mind, the Straw Hacker Group just released their 2025 directory of POS providers. And here are some key findings that I thought would be interesting to
Yeah.
share with folks.
Sure.
41% of those identified as POS providers offer an all in one solution or comprehensive POS solution such as Clover or Toast.
Sure. Right.
12%, this surprised me, 12% market their platforms as processor agnostic.
Hmm. What percentage was that again?
12.
Yeah, that's crazy. Because I mean, like 5 years ago, I think that number would have been 80%, probably
Yeah,
at
I
least
know.
70.
Yeah,
So that's
right? I
that's a that's a
mean,
trend in and of itself, right there.
right there. I thought that was a
Hmm.
really interesting trend. I mean,
And it's like we need to pause that for a second because like our audience needs to hear that number again.
let's hear that. I'll give it to
It
you again. 12% of POS providers market their platforms as processor agnostic.
And so for those agents and ISOs that are like, well, we're okay. We don't need to make integrated payment partnerships because we're going to continue to use processor agnostic solutions. Well, in the last 5 years, and I would love to know what the number was 5 years ago, but I would, if I had to guess, I would say it went from 60, 70% to 12%. So the
Yeah,
question, and it's like, well, why did that happen? Well, the reason that happened is because half of all the POS providers woke up one day and said, what the heck am I doing giving away all my payments margin? And they
right,
decided to do the payments themselves or do a partnership with a company providing distribution or whatever it was. They decided to make payments a core part of their platform. They also realized that the customer experience was suffering because they weren't doing payments as a fully integrated stack, right?
right,
So for a
right.
variety of reasons, it went from whatever it was, 60, 70% to 12. The question is, where is it going to be 5 years from now? Right?
Is it? Right, exactly.
If you're like, well, I'm only offering processor agnostic solutions. Okay. What solutions are going to be left for you to offer in 5 years? That's the question.
Right?
So
Maybe
anyway,
one or two?
yeah. So
Yeah,
that's very important. So
that's
yeah.
very important. Okay, two more data points. 78% of providers in the directory offer at least one product, at least one product with a cloud-based hosting model,
Hmm.
and only 5% still support on-premise deployment. That doesn't surprise me.
Wow.
That
So
doesn't,
wait. So only 5% still support having a human coming and doing the installation on
yep,
site.
yep.
Whew, wow, that's crazy, crazy low number to me. That one actually does surprise me because the reason I say that is like, so here's something that I will say is very interesting. One of these things where it's like, statistics don't lie, but you can lie with statistics.
Right.
Let's talk about something, an interesting thing here. In that report, it's very important, I think, to understand, and I think I'm understanding these numbers correctly, that we're saying of all of the POS providers out there, regardless of size, this is the percentage of those companies that does on-site installation, right? Well, think about this. Which companies do provide on-site installation? Well, let's see. Toast, 6,000 installs last quarter.
Mm-hmm.
right? So
Right.
you think about, okay, but is that a marketing, is that an inevitability of the market, or are POS providers too quickly shifting away from on-site installation when in fact the most successful POS providers are providing that? Now again, it
Right.
depends on the vertical, right? For sure. I mean, it depends,
And there's also another caveat. Remember, this is the directory. It doesn't necessarily. I mean, we know that they got all the big shots, but they don't necessarily have every.
yeah, there's a long tail, but this is why that matters, Patty, because even though there's this long tail effect, in my opinion, that would almost make the numbers even more scary because, in other words, if you're an agent or an ISO and you're like, I'm going to go after these processor agnostic solutions, well, here's what you need to understand. Software development is primarily a money game, meaning my
Right.
solution is going to be as good as I can afford to make it with my return on investment, right?
Right.
So I'm going
Right.
to get more capital if I'm really profitable. I'm going to get less capital if I'm not. Therefore, my solution is going to be really good or it's going to suck depending on the return on capital that I'm able to get. So if you're a processor agnostic solution, you're only making the software money. Now,
Right.
if you're Clover, well, then at scale, you're making billions of dollars off of your SaaS. And even though they're
Mm-hmm.
giving away the payments on most of the deals, not the inside, but the ISO channel, well,
Right.
they can still afford to make an unbelievable solution because it's so big in scale. It's like they make
Right.
one new feature and it impacts a million merchants. So they
Right.
can they can afford to put a lot of money into a feature, even though they're not getting the payments margin. But
Right.
for these smaller, more vertical specific solutions, the ones who are like, oh yeah, we'll be processor agnostic, just pay us $30 a month per account. Well, that the problem is that $30 a month per account for their tiny little vertical, that's actually not enough revenue to support a robust senior developer team.
Yeah.
Therefore, the solution that you're offering is subpar versus the competition.
Yeah. Sure. No,
So
very
there's that you got to
excellent
think
point.
about too.
Yeah. Excellent point. Yeah. Okay, one last statistic. 43% of providers identified retail and 42% identified restaurants as their key verticals.
Yeah, no surprise there.
That
Yeah,
doesn't surprise me at all. But,
right.
and then basically their bottom line is the POS market will continue to evolve as emerging technologies like AI-driven analytics, biometric authentication, and of course, blockchain-based payment systems develop.
Yeah, good stuff. Well, Patty, we appreciate you taking the time to put all this stuff together for us and keep us up to date every week. Thank you for all that you do.
I enjoy it. I enjoy it. My friends sometimes they say, why do you write about payments? And I say, because two things. It's the grease that keeps the system running,
hmm
the the
Yeah,
commerce running, and it's always changing.
yeah, it is. Absolutely. Well, Patty, thank you very much for all you do.
Sure thing.